On April 6, 2016, Chase Bank was celebrating 20 years in business. It had 142 billion shillings in assets. It was ranked the 11th largest bank in Kenya. It had just been named the best company to work for in Kenya 2 years in a row by Deloitte. Its banking halls were full, its staff were proud, its customers trusted it completely. 24 hours later, the doors were chained shut. 55,000 depositors woke up to find they could not access their money. 96 billion shillings frozen. Workers wept in banking hells. Pensioners stood outside locked branches with nowhere to go. The third bank to collapse in Kenya in less than 12 months. And while Chase Bank was dying, Equity Bank was quietly positioning itself to absorb everything Chase left behind. This is the story of how Chase Bank collapsed overnight and how Equity turned Kenya's banking crisis into its greatest opportunity. Chase Bank was not supposed to be a great bank. It started as a rescue. In 1995, a group of Kenyan business people bought 60% stake in a struggling institution called United Bank Kenya, which was already in receivership. They paid 95 million shillings for it, renamed it to Chase Bank, moved headquarters to Nairobi, and started again. What followed was 20 years of aggressive, impressive growth. Chase Bank found a market nobody else was serving properly: the young professionals, women entrepreneurs, investment groups, and small businesses. While the big banks were focused on corporate clients and the wealthy, Chase Bank was in the trenches with Kenya's emerging middle class. It paid some of the highest interest rates in market on fixed deposits. It had a reputation of creative financing. It partnered with women's groups and charmers. It funded startups when other banks turned them away. By 2015, Chase Bank had 142 billion shillings in assets. It raised a 4.8 billion shillings bond on the Nairobi Securities Exchange. French investment firm Amethyst Finance and a European private equity fund had both taken equity stakes. International money validating what looked like a serious institution. It had subsidiaries: Rafiki Microfinance, Chase Insurance, Chase Iman for Islamic banking. It was growing, it was winning awards, it was beloved, and behind the scenes, it was also rotting. The collapse of Chase Bank did not start with an audit. It started with a tweet. In the early April 2016, Chase Bank republished its 2015 financial accounts. The first version had been released without naming the auditor or their opinion, a strange omission that sharp-eyed analysts noticed. The second version revealed that Deloitte had qualified the accounts. That meant Deloitte, the same firm that had given Chase a clean bill of health for 10 years, was now raising red flags. The difference between the two versions was stark. Non-performing loans had jumped from 3 billion shillings in 2014 to 11 billion in 2015. Profit had collapsed from 2.3 billion to a loss of 742 million shillings. And insider loans, loans given to directors and associates, had been understated by billions. The real figure, 13.62 billion shillings in insider loans. One director alone had borrowed 7.9 billion shillings, mostly without collateral. On April 5, 2016, a whistleblower sent an anonymous letter to Amethyst Finance, the French investors, detailing irregularities in Chase Bank's books. The letter pointed to 16.6 billion shillings in problematic loans and assets that were not benefiting the bank. The letter leaked. By the evening of April 6th, it was on Twitter. What followed was one of the fastest bank runs in Kenyan history. By the end of that single day, depositors had withdrawn 8 billion shillings. 8 billion. in one single day. No bank on earth can survive that kind of pressure. Chase Bank went looking for emergency overnight funding from other banks. No bank would lend them a single shilling. At 4 a.m. on April 7th, the Central Bank of Kenya gave up trying to save it. At 6 a.m., CBK officials, accompanied by police officers, walked into Chase Bank's Riverside Drive headquarters. Staff had gathered for a meeting, still believing that the bank would actually survive. But they were wrong. The doors were locked. The receiver was appointed. 55,000 depositors, including the Law Society of Kenya, the United Nations Circle, and betting company SportPesa, found their money frozen. Former chairman Mohammed Khan was later charged with conspiring to defraud the bank of 1.68 billion shillings. The Capital Markets Authority fined executives millions and banned them from the Kenya's financial markets for years. Chase Bank never reopened as Chase Bank. In 2018, 75% of its deposits and assets were transferred to SBM Bank Kenya. The remaining 25% went to Kenya Deposit Insurance Corporation. In 2021 liquidation, the institution that had taken 20 years to build was gone in 5 years. While Chase Bank was collapsing, Equity Bank was having one of its best years. In 2016, Euromoney named Equity the best bank in Africa. The Banker magazine ranked it the fastest growing big bank on the continent. It was Kenya's best bank by virtually every metric that mattered. But Equity's advantage in 2016 was not just its award, it was its positioning. Equity had been built on exactly the customers Chase Bank was now abandoning: the ordinary Kenyan, women entrepreneurs, the youth, investment groups, and small businesses, the so-called unbankable. Equity had been serving them since 1984 when nobody else would. When Chase Bank collapsed, tens of thousands of those customers needed somewhere to go. They needed a bank that understood them, a bank that had always understood them. Equity was there, the bank that did not make dramatic announcements. It did not run campaigns targeting Chase customers. It simply kept its branches open, kept its agents ready, and kept its products accessible. The result spoke for itself. In 2016 alone, the year of Chase Bank's collapse, Equity's mobile banking platform Equity grew from 1.6 million customers to 2.7 million. Its agent network expanded from 23,885 to 29,561 across Kenya. The banking sector's crisis became Equity's opportunity. Every bank that collapsed sent its customers looking for safety. Equity was the safety, most trusted, most accessible bank in Kenya, and it kept growing. By 2024, Equity Group had 21 million customers across 7 African countries, total assets of 1.7 trillion shillings, net profit of 48.8 billion shillings. In April 2026, at the 22nd Think Business Banking Awards, Equity was named the best overall bank in Kenya again. The bank that Chase Bank's customers ran to is now undisputed king of East African banking. Chase Bank and Equity Bank were both built for the same customer: the ordinary Kenyan, the entrepreneur, the charmer, the small business owner. Chase Bank tried to get rich serving them and ended up stealing from them. Insider loans handed out to directors, accounts falsified, a whistleblower letter that brought everything down in 48 hours. Equity Bank spent 30 years genuinely serving them. No shortcuts, no financial engineering, just relentless access, discipline, and conviction that ordinary people deserved a real bank. When Chase collapsed, its customers did not leave banking. They left Chase and they walked straight into equity. The banking business, like every business, is built on trust. You can fake trust for years. You can hide the loans. You can qualify the accounts. You can pay the highest interest rates to keep people from asking questions. But when the tweet lands, and the tweet always lands, the only thing that survives is the truth of what you built. Chase Bank built a lie. Equity Bank built a bank. That was the insane story of Chase Bank versus Equity. Subscribe because on this channel we are just getting started.